Our guest is with us, the market master for the day, Sandeep Bhatia, Executive Director and Head of Sales at Kotak Institutional Equities. Good morning, Sandeep. Good to have you with us on a day which we find a bit confusing. What's the immediate shorter-term call? Do you think the correction we saw in both the global markets and the Indian markets is over for now? It was just a routine end-of-year profit-taking?
I would think so. I don't think that I would expect any major fall in the markets in the next 2 weeks. That should not be the case. As Uday has been saying for the last couple of weeks, that God is an Indian. So a lot of things which have happened for India have been very positive in the global macroeconomic scenario. So we have seen major correction in oil prices. Even if the RBI has not cut rates, we've seen our 10-year bond yields come off. The broader economic pickup is still to happen, but that would probably, as I've been saying for some time, is 6 months away. So on the whole, I think India is in a much better spot as end of 2014 than most of the world. We can look around ourselves and we'll see that fact. So I would think market should hold steady here.
Okay, market should hold steady here. Sandeep, hi, morning. The biggest positive, for the next, say, couple of weeks or months could be the rollout of GST. At least that's the indication you get from various experts that you speak to. In your mind, how does one really play that? What are the sectors or stocks that could benefit from GST?
There are lots of issues on GST which need to be known before we make any broad or specific statements in terms of sectors. The first, we still have to see, what is the timeline of this. It will probably be April 16 is the assumption. But if that happens, I think the first 1 year is just ironing out the differences. Maybe we'll start at a higher tax rate because there is a risk and there is an outlook that the state governments need to be compensated. So I don't think there will be a significant decline in taxes paid by businesses at all. It only will first simplify matters. It will allow the movement of goods to take place. So the real impact of GST in the first 1 year would be to give simplicity to the entire taxation process and make the movement of goods better across the economy. Only when we see state governments getting more assured that there is no big decline, especially even octroi is supposed to be clubbed in. So if we see that also, the local bodies, the municipal bodies also get their share of taxes, only then will tax rates start falling. That will probably be after the second year. So the first couple of years is just simplification. And actually, I would think, therefore, the entire economy benefits. If at all, if there's any sector that benefits, potentially it is the car sector, because higher-end cars probably have taxes which are in excess of 45%. And in GST regime, they would be in the region of 24 to 27%. So clearly, there's some benefits in top-end cars, but broadly, it's a macroeconomic benefit, and the real benefit will flow in after 2 years if tax rates fall.
Okay, so that's not the game to play right now. Sandeep, is there a general re-rating possible now? I guess oil has been, and the impact of that on India has kind of been factored in. We have been seeing our markets move positively, except until the recent correction. What about positives like actually the GST amendment bill has gotten passed, as well perhaps the insurance bill as well before the winter session wraps up. We are ahead of a budget where a lot is expected. Is there a possible, fresh record highs that we can set pre-budget?
Lata, any kind of re-rating always is temporary unless it is accompanied by fundamental improvement in earnings prospects of the corporate sector. So yes, in the short term, you will see good outcomes on elections. You will see the Jharkhand, as per exit polls, BJP being the majority party. Even in J&K, they would have the best ever performance. In Delhi, the opinion polls which are coming through are saying that they seem to be in the lead. So clearly, the electoral cycle will continue to give you good news. Does the economic cycle follow? One would expect that to happen in the second half, but yes, fresh highs can happen around the around the budget. Maybe most likely it will happen before the budget and after the budget, because market always runs ahead of itself and continues to build expectations to an extent at which finally not all these expectations eventually come through immediately. So clearly there could be fresh highs before the budget, and after the budget we all would be discussing that it was good but not as good as what we wanted. So anyway, this is just a cycle of building expectations that the market always does. I think the real issue still is that we need to see bigger momentum pick up, and I think one thing which is now coming through in what we have been reading in the newspapers for the last 1 week is that now the government realizes that actually the government itself will need to start raising its spending for the capex and investment cycle to pick up. And I think this is something which in banks a lot of people know, that it is not that a lot of big corporates have the balance sheets now to take even more leverage and to start building even more capacities. So in fact, capacity utilization in the economy is very low, and in fact, fresh capacities, if at all, will get added from the corporate sector after 3 to 5 years. So actually the government needs to now start spending.
Okay. So what else, Sandeep? I mean, as we head into the budget, apart from government spending, what are the other 1 or 2 crucial factors that you would watch out for that would be make or break for the budget this time?
No, I would say again, the markets have a tendency to put everything in the budget. We should not do that. Governments continue through the year. In the budget, what one needs to see is a clear roadmap of how the entire economic cycle, whether coming from the government side or whether coming from further liberalization in foreign direct investment, can kickstart the investment cycle. I think that is the only thing that I would fundamentally expect from the budget. Other than that, it is all in the realm of legislative changes. And once we see the upper house, Rajya Sabha, also reflect the majority of the NDA, then I think legislative changes would be much faster. So that would be a 2-year time. So in the budget, it is more about the capex cycle picking up and allowing greater investments coming through both from the government side and the foreigners.
Okay. And there was a bit of a shudder in an article in the Mint which said that is the government going to give the fiscal targets of a go-by. That looks a little scary. I mean, you do want the government to spend at a time like this. They alone can kickstart spending. But it is the quality of the expenditure that one looks at. You know, you trim something and you put more in investments in a Delhi-Mumbai corridor or something which can crowd in private investment. It's a little scary, the Mint interpretation, and one hopes that's not true. But on that point, actually, you know, a twofold point, Sandeep, let me get that out of the way and then talk specific stocks with you. One, can the government really monkey around with the deficit, or will the foreign investor opinion be fairly serious about even the qualitative aspects of how the deficit number is arrived at? And two, off and on we get this disturbing news about the RBI governor and the BRICS Bank, idea. How would the financial markets react? The finance ministry and the government sources scotched it completely. But if this bogey were to, win again, how would the financial markets take it?
So, I think the markets like the work that the Reserve Bank of India has done, and also the way the governor is a steady hand. So I think clearly if there is any midway leadership change, there could be jitters in the market. I think that's not on the card, so that's a great thing. I also think that, to say that the government will give the fiscal deficit numbers a go by would be actually too aggressive a way of putting it. Clearly, we have seen a big compression of spending. As far as the government is concerned, actually in GST, tax rates will most likely go up in the near term, as I've tried to hint in the beginning of this conversation. So in terms of taxes, government would be very well placed if the cycle picks up from June onwards. That will also show up in tax collections. So it is important that the government identifies a couple of key projects and targets investments in those areas which can basically kickstart the investment cycle, rather than broad brush spending or maybe salary increases or that kind of consumption spending which the government can do. I'm not at all hinting for that. It requires some amount of thought. It requires some amount of deliberate planning, that wherein the state government and the central government come in together and kickstart. We can see that happen in Maharashtra. We can see that happen in Bombay. I think these are, this would have a large impact if in certain states, in certain parts of the country, both the on-the-ground impact and the psychological impact of government spending could be higher. So it requires some amount of deliberate thinking, and it should be much more targeted, which is what I would say.
All right, that's about all the macros, Sandeep. But what about the stocks and the sectors itself? Now that the global fears are out of the way, at least for now, what are the stocks or sectors that you would advise accumulating ahead of the budget?
Interest rate sensitives and consumer durables is where one should be positioned. For a long time, we have talked about the banks. We talked about IndusInd Bank. We talked about LIC Housing. One other stock that one can look at is Max India. So that's a business which has significant potential. We have seen interest build up in the insurance sector. So Max India is something which we initiated on just 2 weeks ago, and we see good potential for the insurance business of Max India. It's a high quality play, and that's one name in the financial sector that one can look at. If you step outside of the NBFCs and the banks, then clearly I would look at Maruti. This is both an interest rate sensitive and also a very well entrenched player in the car business. We expect new models to come through in 2015. Market share should remain steady, if not inch up. And of course, the fact that the Japanese yen has corrected mean margins. It would give a big fillip to margins as far as Maruti is concerned. So we like that stock.
All right, Sandeep, thank you very much for joining us with your take on that bunch of macros as well as some of the micro stocks you spoke about. Since you spoke about stocks, any disclosure you specifically want to say?
No, that's fine. I don't hold any of the stocks that I mentioned.
Fair enough. Thank you very much, Sandeep. Pleasure speaking with you. And if we don't speak before the new year, have a great 2015.